Nuburu Inc., trading under the ticker symbol BURU on the NYSE American, closed its last trading session on June 16, 2026 at 4 p.m. EDT at exactly 0.147 cents per share, marking a daily decline of 2.78%. This price movement follows a highly volatile intraday session where the stock opened at 0.1489, pushed to an intraday high of 0.15, and slid to a low of 0.141 on a massive trading volume of over 22 million shares. While most retail traders looking at this price action assume they are watching a typical dying penny stock slipping towards insolvency, the reality hiding in the company's recent regulatory filings reveals a massive corporate reshaping. Beneath this sub-15-cent share price is an aggressive, multi-layered restructuring campaign involving international acquisitions, a fundamental shift into military defense applications, and a complete financial engineering playbook designed to lift the company out of a deep capital deficit. The typical market perception surrounding the BURU is that it is an early-stage industrial laser manufacturer struggling to commercialize its high-power blue laser systems before running out of operating cash. Investors watching the ticker on popular online investing spaces or tracking minor updates on Robinhood frequently view it as a high-risk gamble burdened by continuous dilutive financing and a strict delisting warning from the NYSE American exchange. However, a deeper look into their first quarter financial statement for the period ending March 31, 2026 tells a much more complicated story. The company pulled off an unexpected paper turnaround, reporting a massive reduction in its net loss, which plummeted to just under $460,000 compared to a staggering $16.6 million net loss during the exact same three-month period last year. This sudden dramatic narrowing of their net loss was not driven by sudden explosive commercial sales of their standard blue lasers, but by massive non-operating fair value gains recorded on their outstanding warrants and corporate debt structure. This creates an intense point of friction between short-term technical performance and long-term structural adjustments. If you pull up the stock on standard tracking apps or use institutional trading software like Interactive Brokers, the historical charts show a relentless downtrending line, with the asset losing more than 90% of its valuation over the past 12 months. Retail sentiment across self-investing forums is understandably pessimistic because the company had to execute a dramatic 1-for-4.99 reverse stock split back in February to artificially prop up its share price. Yet, institutional activity and specialized corporate actions show that management is furiously pulling levers behind the scenes. They successfully wiped out a massive $8.1 million preferred obligation tied to their previous transactions by exchanging it for the future issuance of roughly 10 million common shares, while simultaneously reducing their Series A preferred stock liability down to $13.4 million. This aggressive cleaning of the cap table allowed Nuburu to report positive stockholders' equity of $2.17 million, a major pivot from the deep $15.2 million equity deficit they carried at the end of last year. To fully understand why this microcap stock is experiencing such heavy volume, you have to look at their rapid-fire corporate acquisitions in the European market. Management has fundamentally altered the business layout by consolidating Italian tech entities Orbit and Lyocon directly into their financial reporting ecosystem. This structural shift allowed Nuburu to book its first true operational revenues of just over $407,000 in the opening months of this year, a sharp contrast to the absolute zero revenue recorded in the first quarter of last year. This operational shift is gaining unexpected operational speed. Just weeks ago, they announced that through their newly integrated subsidiary Lyocon, they secured a critical contract to design custom blue laser technology for SunCube's deep light underwater power platform, showcasing an immediate tangible deployment of their engineering assets. Comment below how many shares of Nuburu you currently hold or if you are tracking this stock from the sidelines. The financial engineering does not end with minor commercial agreements. The company is pushing deeply into heavily protected sovereign technology sectors. They recently executed a formal golden power notification filing with the Italian government to clear the path for their majority acquisition of Tekne, a prominent European electronic defense and infrastructure provider. Because Tekne operates within critical strategic sectors, the acquisition triggers a highly formalized regulatory review by national security agencies in Italy. In tandem with this European expansion, the company announced its dedicated laser arm initiative, explicitly targeting the defense and security sectors, with a hard focus on directed energy weapons and counter-unmanned aircraft systems. This reveals that management is trying to pivot away from low-margin industrial manufacturing and reposition the company as a specialized defense technology contractor. Despite these strategic maneuvers, the critical question dividing long-term bulls and short-term short sellers is whether the company can outrun its immediate liquidity crisis. Even though total assets on the balance sheet surged to over $76 million due to the integration of Orbit and Lyocon, the underlying business remains deeply capital deficient. Operating cash outflows reached a heavy $9.1 million for the quarter, leaving the company with a rapidly dwindling cash reserve of $8.3 million. In the risks disclosure section of their latest financial statement, management explicitly stated that there remains substantial doubt about the company's ability to continue as a going concern over the next 12 months, pointing directly to their heavy debt obligations, constant negative cash flows, and severe reliance on dilutive equity financing programs like their standby equity purchase agreement.
Furthermore, the clock is ticking loudly on their regulatory status. The NYSE American exchange has placed the company under multiple non-compliance notices due to their prolonged low stockholders' equity levels. Under their currently accepted compliance plan, Nuburu has until October 29, 2026 to fully restore its equity thresholds to required exchange standards or face an immediate catastrophic delisting proceeding that would force the stock off major trading networks and onto the illiquid over-the-counter markets. This regulatory deadline creates an incredibly tight window for management to finalize the Tekne acquisition, stabilize their balance sheet, and generate enough verified asset value to satisfy exchange regulators. When you strip away the complex corporate restructuring and foreign acquisitions, the core of this business is rooted in its proprietary blue laser technology. Founded as a specialized hardware developer, the company holds foundational patents on high-power industrial blue lasers, which operate at a fundamental wavelength of 450 nanometers. In physical manufacturing, blue light is absorbed by highly reflective industrial metals like copper, gold, and aluminum at a rate up to 20 times higher than standard infrared laser systems. This physical property allows their systems to weld and process critical electronics components with extreme speed and zero defects, making the technology highly relevant to electric vehicle battery manufacturing, consumer electronics assembly, and advanced aerospace production. Historically, however, the company struggled with high manufacturing costs, slow commercial adoption cycles, and an inability to scale production without consuming vast amounts of investor capital, leading to the severe multi-year dilution that hollowed out early investor positions. Looking ahead, the investment thesis for this microcap stock sits entirely on the razor-thin edge between systemic risk and restructuring opportunity. There are two clear contrasting paths for how this situation plays out over the next few quarters. In the bullish scenario, the Italian government grants full clearance to the Tekne acquisition, allowing BURU to fully consolidate a revenue-generating defense contractor onto its books, which would instantly solve its exchange compliance equity issues before the October deadline. This, combined with their new counter-drone defense initiatives, could allow them to secure high-value government contracts, driving institutional interest and forcing a massive short squeeze on a heavily shorted low-price ticker. Conversely, the bearish scenario is rooted in cold mathematical reality. If the administrative integration of these foreign subsidiaries stalls, or if the Italian regulatory bodies block the transaction under national security asset protections, Nuburu will remain trapped with a high-burn operating model, inadequate revenues, and an unfulfilled compliance plan. This outcome would almost certainly trigger an exchange delisting, rendering the stock highly illiquid and forcing a final dilutive capital raise that would further compress the valuation of existing equity holders. Ultimately, the market is pricing the asset at 15 cents because it expects structural failure, while management is trading assets and rewriting liabilities to prove that the reality of their transformation will completely shatter those expectations. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Thank you. Don't forget to like, comment, and share this video to support the channel.